Hey guys, now we got to start India's 101, which is first time adoption of India's. So this standard, in a way, it is something which is applicable only once in the lifetime of any company which is applying India's for the first time. Because once we start applying India's as any entity, it has to continue applying India's. We have learned that in the roadmap and all. They cannot roll back into normal AS and all, even though they adopt India's voluntarily. So this standard is applicable when the entity prepares first time its India's based financial statements. Now what is there in the standard and all, I'll just give you a brief understanding, then we'll go into the standard, then parallelly we'll try to make some notes out of it. Now listen sir, I'll try to remind you something which you are already aware of because of the discussions we had in the roadmap to India's sessions in the initial days. So it's like this. Now for example, an entity has to apply India's mandatory, let's say from 1/4/2019. Let's say an entity has to apply or getting covered under India's for this period. So for this period, the entity has to compulsorily prepare its first time Ind AS based financial statements. Now what we discussed the initial days is when you are preparing Ind AS for the first time, even the comparatives also must be given under Ind AS. Now comparatives for this period would mean, for this means this period, which is 1/4/2018 to 31st March 19. Originally you have prepared AS based financial statements for the year 2018-19 and you might have issued it to the public and all. But now just for the purpose of 2019-20 financial statements which are going to be prepared under Ind AS, in those financial statements comparative column we need 2018-19 financial statements also under Ind AS. So they have to be now prepared, which we call it as restated as per Ind AS. You must understand one thing. Preparing financial statements under Ind AS means what? It is like applying all the Ind ASs we have for every transaction and events. You have to apply Ind AS and you have to follow all the presentation requirements, disclosure requirements and all, which anyway the company has to do, for this period anyway. But they have to do even for this period also. But this period is already accounted under old GAAP, which is accounting standards in India. So even though they have already accounted it, again all the transactions of 2018-19 have to be re-accounted as per Ind AS. That means if a company has to apply Ind AS financial if the company has to present Ind AS financial statements, for example for this period, it is as good as the company is applying Ind AS not in just this year, even in this year also, because they have to prepare comparatives also. So for that reason, it's as good as you are applying Ind AS from 2018-19. Now when you rewrite journal entries and all, apply all the measurement rules as per Ind AS and all, the balance of assets and liabilities obviously will change. So whatever balance was there on 1/4/2018 earlier, that asset and liability balances are going to change. Now when you write entries, obviously the account balances will change. Now the problem is on 1/4/18, whatever opening balance of assets and liabilities we have, they are originally measured earlier as per AS. Now what this standard says is, what Ind AS says is, from here after anyway you are virtually applying Ind AS, even 18-19 of course to 19-20. But you are applying Ind AS entries and all on account balances which are originally measured under previous GAAP, which is accounting standards. We cannot do that, no. So what Ind AS requires is, on this 1/4/2018 you got to prepare a opening balance sheet. This opening balance, just for your understanding, I'm drawing a T-shape format. This opening balance sheet should consist of asset liability items, all equity and all, as per Ind AS. You already prepared a balance sheet earlier on this date, but that was as per AS. In fact, of course, 31st March 18th you would have prepared. under AS. Now convert that balance sheet into Ind-AS. That means all the asset, liabilities, everything. Had you applied Ind-AS from the very beginning, what numbers would have been there against each asset, each liability, what are the classifications, everything, as if Ind-AS was followed from the very beginning. How, if you follow Ind-AS from the very beginning, how your balance sheet would have appeared on 1418, like that you have to draft. This is called as the starting point of your Ind-AS applicability. Once again, sir, nothing to get confused. 2019-20 you have to prepare Ind-AS financial statements. Look at the chart there. 2019-20 you have to prepare. But if you have to prepare 2019-20 Ind-AS financial statements, 2018-19 also comparatives have to give under Ind-AS. So even 2018-19 also have to apply Ind-AS. 2018-19 if I have to apply Ind-AS, 2018-19 ka starting, which is 1/4/2018, on that date I need to have an opening balance sheet which is prepared as per Ind-AS. And this date, if you remember, this date 1/4/2018 is called as transition date or date of transition. Okay, now the general rule goes like this, sir. While preparing this opening balance sheet as per Ind-AS, it should appear as if Ind-AS was applied from the very beginning in this entity. That means indirectly each and every Ind-AS retrospective effect has to be given. Just imagine, sir, companies which have been in existence for so many years, if you ask them to suddenly apply Ind-AS retrospectively on each and every item that's appearing in your balance sheet, it is not going to be an easy task, and in some cases it's really impracticable also. So in this standard, what we are going to learn is standard has given certain mandatory exceptions and optional exemptions from retrospective effect. Who gave this? Ind-AS 101 has given. So this standard is all about you preparing that opening balance sheet as per Ind-AS. While preparing that opening balance sheet, general rule you have to give retrospective effect and apply all the Ind-AS in that. But for some items, some transactions, they have given exceptions and exemptions. Sir, what is the difference between exceptions and exemptions? See, when I say mandatory exception, it means you are not allowed to retrospectively apply Ind-AS. Sir, this is strange because normally Ind-AS will ask you to apply retrospective effect, isn't it? But why the standard itself is saying that do not apply Ind-AS retrospectively, you have to apply Ind-AS only prospectively. Sir, why like that, sir? What is the problem? See, the exceptions, there are 6 or 7 exceptions in that category where you are not supposed to do retrospective effect, you have to do Ind-AS applicability only prospectively. The reason for that is in most of the exceptions what they have mentioned, it requires judgments or informations relating to a past date. See, even though you are preparing transition date balance sheet here, you for applying transition date balance sheet as per Ind-AS, you might have to know some past informations and all that may not be available with you, or that can be obtained only with a large range of estimation. So for that reason, certain categories they have been exceptions. The other one is optional exemption. That means if you want to follow retrospective approach, you can do that. If you do not want to follow retrospective approach, then we have some exemption for you. So general rule is like this: you have to apply everything retrospectively. General rule is you have to apply every Ind-AS retrospectively in this opening balance sheet. Some exceptions, some exemptions are there. Exception, you are not supposed to do retrospective. Exemption, you have a choice. If you want, you can skip retrospective effect, or if you want to apply Ind-AS from the very beginning, you are free to do that as well. Okay. Now, there are some small definitions and all. Now, sir, one thing you must understand: This standard, as you must have observed by now only, it's very practical oriented. And your study material, though they have added some 3 or 4 questions in this module recently, they are not so great in number. And the standard is a very lengthy standard. So it is not very advisable and also not practical for us to cover all the exceptions and exemptions. All important ones definitely we will cover in such a manner that it will enable you to solve all the questions given in RTPs, MTPs, study mat and all, whatever ICA resources questions are there, everything will be able to cover. But covering all the exceptions and exemptions given in the original NDAS 101 is very time taking, and examination point of view not suggested also. So some we are going to cover, only few we are going to cover, the most important ones which are also relevant from examination perspective. There are more, some 7 or 8 principles which we may not be covering. You can go through on your own. The material I have given it, but on that there are no examples, no questions also. If there were questions, at least we would have covered, but they are not relevant for us, at least from an examination perspective. Anyway, sir, let's move and see what is given in the standard. You can move on to page number 628. Okay, whatever I have spoken, that exemptions, exceptions, all these they have given. Okay, let's read this. You can also mark and parallelly read. The objective of this NDAS is to ensure that the entity's entity's first NDAS financial statements and its interim financial reports for the part of the period covered by those financial statements contain high quality information that is transparent for users and comparable. Sir, when you are preparing NDAS based financial statements for the first time, there are a lot of adjustments and all you have to do, because a lot of items need to be retrospectively affected. So it is important that you present all the information very transparently. Otherwise the reader cannot understand what all adjustments you have done. So what adjustments you have done, how to give disclosure, how to give reconciliations, all that requirements are mentioned in the standard. So the standard ensures that the information is provided, high quality information is provided, which is transparent, and provides us to suitable starting point. As we have discussed, the suitable starting point is what? The opening balance sheet which the entity prepares on the transition date, that only is the suitable starting point, at a cost that does not exceed benefits. That means, see, at a cost that does not exceed benefits, in the sense, for a small item, if I ask you to do retrospective effect, it may involve lot of cost in terms of time, manpower, resources required and all. In those cases and all, which is where it is very difficult to obtain information and do retrospective effect, the standard itself has given exemptions and all there. So the last point is to tell you that the standard contains certain exemptions and exceptions. Next, some definitions are there. Let's go through it. First, India's financial statements. Now they have defined what is first India's financial statements. Now on an outset it appears very silly that, sir, what is the need to define that? Don't we know which one is the first time India's financial statements? Whenever the entity prepares financial statements as per India's for the first time, automatically that only will become the first India's financial statements, isn't it? That is true, but what this standard puts one small rider is, if you remember in India's one, of course, very long time, you might not remember also, but India's one of the most important point it is, when an entity prepares financial statements as per India's, it has to make a explicit and unreserved statement of compliance that it has complied with all the India's. You remember that? So as per India's 101, first India's financial statements are those financial statements where the entity prepared financials as per India's by complying with all the India's, and they have given the statement of compliance there. That explicit and unreserved statement of compliance should be there. In which financial statements such a statement is there for the first time, that financial statements only is treated as first India's financial statements. Let's read this. The first annual financial statements in which an entity adopts India's by an explicit and unreserved statement of compliance with India's, those statements are called as first time India's based financial statements. Only in those statements, means, see, why it's important to define that financial statements is based on that we determine the transition date, and transition date balance sheet, all these exceptions, exemptions and all you can enjoy in that. So in the first Ind AS financial statements, if I know the period, based on that I'll be able to identify the transition date, and on that transition date I can claim all the exceptions and exemptions given under the standard. For that reason they are highlighting. In our example, what we just now discussed, this happened to be the first Ind AS based financial statements period. Based on this, we define this period, transition date. Our transition date, we have to prepare an opening Ind AS balance sheet. Our opening Ind AS balance sheet, how to prepare? Our guidance is standard is giving us. This means compliance with all Ind ASs. Partial compliance is not enough to make entity Ind AS compliant. So this is one definition. Next, first time adopter. Who is first time adopter? Whichever entity is preparing the first time Ind AS based financial statements, that fellow is only called as first time adopter. Big deal. Opening Ind AS balance sheet. An entity's balance sheet at the date of transition to Ind AS. Now what is date of transition? The beginning of the earliest period for which entity presents full comparative information under Ind AS in the first time Ind AS financial statements. First Ind AS financial statements in our example is 1920. 1920 year की comparative is 1819. ये 1819 का financial state 1819 period का beginning date, which is this one. This period is that date is called as the date of transition, the beginning of the earliest period. So this is the earliest period for which we are giving comparatives. Our period ka beginning, there is one for 18 there, but transition date. The same example, sir, you can go through this example very base level. First Ind AS reporting period. Ind AS reporting period means, see, look at this timeline. What do you feel if I ask you which one is the first Ind AS reporting period? Means technically speaking, practically speaking, 2019-20 anyway we have to prepare under Ind AS. 2018-19, even though in the past I prepared under AS and I have given financial statements to outside and all, for the purpose of comparatives, even 2018-19 also I am preparing under Ind AS. Now which one is first Ind AS financial statements period? Means only current year. First time you are basically required to prepare Ind AS for this year. So this will become the first Ind AS reporting period. So just because you are preparing even 18-19 under Ind AS does not make 18-19 as first Ind AS reporting period. First Ind AS reporting period is 1920, the latest period. That's why the language also is given like that. The latest period covered by an entity's first Ind AS financial statements. Because in our example, 18-19, 1920, both you are preparing under financial statements, under Ind AS only. But 1920, the latest one is called as the reporting first Ind AS reporting period. Because 18-19 you never give Ind AS financial statements to outsiders. So you are giving in 1920, 1920s and 18-19s under Ind AS. So first Ind AS reporting period will become 1920. Example for that is basically. Now what is deemed cost and all, we will see it later on. Previous GAAP. This GAAP stands for you must understand generally accepted accounting principles. So in this standard, wherever they refer to previous GAAP, you must understand that it is accounting standards. Okay, basically it's that. But how they have defined, let's read. The basis of accounting that a first time adopter used for its statutory reporting requirements in India immediately before adopting Ind AS. Stop there. So whatever accounting principles an entity has applied, okay, in India for statutory reporting purposes, such accounting principles are called as previous GAAP. Now, as on today, Ind AS is applicable only for companies. Okay, so companies before they got covered under Ind AS, they have to mandatorily apply what? Accounting standards only as per Companies Act rules. So obviously, the accounting standards only will be treated as previous GAAP. For instance, companies required to prepare the financial statements in accordance with Section 133 of Companies Act 2013 shall consider those financial statements as previous GAAP financial statements. Those previous GAAP financial statements were prepared as per Companies Accounting Standard Rules 2006. and hence such accounting standards are previous GAAP for those companies in India. Okay, on this one question, see this question, some of the questions which is added in the study material, they are not like application of the principle discussed above. Not all questions are like that, but some are. Some questions, normally what do you expect after reading a principle? On that principle, some example of question should be there, but not all questions are like that. Here some questions are taken from the educational material, where institute have answered some queries after applying India SS. So queries ke answers are, means it's related to this principle only, but you cannot directly answer this based on what you have studied above. So some questions may appear new to, means the matter covered in the question might be new, though related concept only, but a new point. So even the questions are kind of a learning mode for us. It's not like applying of what we have learned. Some are like that, some are like this. Let's see. Company B is a foreign subsidiary of Company A and has adopted IFRS as issued by IASB as its primary GAAP for its local financial reporting purposes. Okay, so Company A, assume that it's in India. Company B is a subsidiary of A, but it's a foreign subsidiary, so they normally apply IFRS. Company B prepares its financial statements as per accounting standards specified under 133 of Companies Act 13, read with Rule 7 of Companies Account Rules for the purpose of consolidation. Obviously, A needs to prepare consolidated financial statements. For that, B's financial statements again have to be translated as into A's, and then only we can do consolidation. On transition of Company A to Ind AS, what would be the previous GAAP of foreign subsidiary Company B for its financial statements prepared for consolidation with Company A? So I hope you understand the question. Otherwise, I'll just tell you, put this in a very simple words. Sir, I am a Indian company. I am following normal accounting standards. I have a subsidiary B. That fellow is a foreign entity. He is preparing financial statements on their own in IFRS. But every year when I do consolidation, I cannot consolidate IFRS based financial statements into AS based. No, so what we are doing is, we are converting that foreign company's foreign subsidiary financial statements into accounting standards, and then we are doing consolidation in India. This is what is happening. Now what happened? This Company A, which is in India, has migrated to Ind AS. Now they have to prepare Ind AS. Now you must remember, when a company is preparing its financial statements under Ind AS, it's a subsidiary and all its associate joint, which all also have to prepare it under Ind AS. You know that. So this foreign company financial statements also will be hereafter converted as per Ind AS, and then only consolidation will be done. That's not the question here. The question is, what is the previous GAAP for this Company B? Because Company B financial statements also hereafter will be prepared under Ind AS for the purpose of consolidation. Okay, so Company B, foreign company, also will follow Ind AS just for consolidation purposes. So now that foreign Company B is also a first time adopter, what is previous GAAP for Company B? And he's asking. We have two possible answers. Number one, possibly answer one is IFRS, because Company B on its own follows IFRS. Number one. Number two, accounting standards. What do you feel? Okay, there is a hint in this. Look at this. The basis of accounting that a first time adopter used for its statutory reporting requirements in India. In India, which accounting principles the company followed before they migrated to Ind AS? That accounting principles will become previous GAAP. Company B on its own is following US GAAP. Company B on its own was following IFRS, but Company B in India was not following IFRS. No, in India, Company B financial statements were always translated into accounting standards. So AS only will become the previous GAAP for Company B. So that one is that is a core word. Accordingly, the previous GAAP of the foreign subsidiary for the purpose of consolidation under Ind AS with the parent company would be accounting standards specified under section 133 of the Companies Act. So that is that, sir. Okay. This point earlier also we have discussed, but anyway, I'll just remind you this point. Sir, I am a company, sir. I have first time applied my Ind AS into financial statements, where I also have given a statement, an explicit and unreserved statement of compliance that we have complied with each and every Ind AS we know and all. Fantastic. However, auditor has disagreed that this entity did not apply one Ind AS up to the satisfaction of Ind AS or something like that. Auditor has commented in his report, he has qualified the report. Now the question is, when entity said it has complied with all the Ind ASs, will it be sufficient, or we have to check even the auditor's report? See sir, question even while doing Ind AS 1 also we have done, again same point, same answer also. The answer, if you remember, is what? It's the responsibility of the management to prepare financial statements. If management has told that they have prepared financial statements in compliance with Ind AS, that's all we have to see. Of course, if the auditor does not like, he will qualify it in his report, but for the purpose of this standard, that financial statements in which management has given explicit and unreserved statement of compliance for the first time, that financial statements only will become first Ind AS based financial statements. So that question. Okay. Opening Ind AS balance sheet. An entity shall prepare and present an opening Ind AS balance sheet at the date of transition to Ind AS. This is a starting point for its accounting in accordance with Ind AS, like the opening balance sheet. So mandatory exceptions, optional exemptions he is talking. Let's see this. Okay, let's, before we read all, sir, whatever I'm taking you mark it, but anyway I'll make you give some summary. The general principle of Ind AS 101. It may be noted that the way Ind AS 101 is structured, it first lays down the general principle that all Ind AS as effective for the first Ind AS reporting period should be applied retrospectively. So all the Ind ASs have to be applied retrospectively. Where will you apply retrospectively? Our opening balance sheet is there, no transition date balance sheet. Our balance sheet lo all Ind ASs must be applied retrospectively on each and every item, which is the opening Ind AS balance sheet should carry the balances as if Ind AS has always been applied by the company in the past. Sir, so many items are there in the balance sheet. For each and every item, if I have to apply Ind AS, it may not be very practical and all. Yes, that is the reason the standard has given, this standard has given you exceptions and exemptions, which we will study. Now, before we go into the exemptions and exceptions, let us see the general principle first. There are 4 points, sir. If you want, you can write some examples also side by side. I'll be giving you. So, in the Ind AS balance sheet, you prima facie have to do 4 things, sir. 4 things. Number 1, recognize all assets and liabilities whose recognition is required by Ind AS. Now, there are some items which are not treated as assets and liabilities as per AS, but under Ind AS they are assets or liabilities. Example, that fellow here they themselves have given. Example for this is derivative financial asset or financial liability. Suppose you bought an option. When you buy an option, you are an option holder, you recognize it as a financial asset. You wrote an option, we will recognize it as a financial liability. But there was no such accounting in the old AS. So what you might have done, you might have booked the premium paid as an expense in your P&L account. That is wrong now. You have to recognize it as a financial asset right now. So recognize assets and liabilities. Okay. Similarly, earlier when you have revalued your asset under AS, whatever profit is there on revaluation, we used to call it as revaluation reserve and park it in the balance sheet. Now if you remember, after doing Ind AS 12 and all, on such revaluation surplus also you have to create a deferred tax liability, isn't it? Such requirement was not there in the old accounting standard. Now you have to recognize TTL on so recognize now assets and liabilities which are required by Ind AS. Not recognize items as assets and liabilities if Ind AS do not permit such recognition. Now you have recognized some assets and liabilities in your past balance sheet, AS based balance sheet, assets and liabilities are there. But those are not to be treated as assets and liabilities as per Ind AS. Remove them, write them. Okay, next. Reclassify items that it recognized in accordance with previous GAAP as one type of asset, liability or a component of equity, but are a different type of asset, liability as per Ind AS. So reclassification, a classic example is preference share capital. Redeemable preference share capital, you all know, as per Ind AS 109, you have to classify it as financial liability. But in the old AS, we used to group it along with the share capital and show it under the heading of equity. That is wrong, no? You have to reclassify. Correct, no, sir? For example, I have a fully convertible debenture. Fully convertible debenture, let's assume that interest is also discretionary. It's a core equity item, but we used to group it under long-term borrowings. That is wrong, no? So reclassify. Example, preference share capital, convertible debentures, even non-controlling interest. Earlier, non-controlling interest, or which we used to call it as minority interest, we used to group it under liabilities. Since some of the entities follow that, now it's very clear. You have to show it separately or park it as a part of equity. Apply Ind AS in measuring all recognized assets and liabilities. Measurement. First he spoke about recognition. Recognize some things which are not there. Second, he is saying something which are not there as something which are there as per AS but need not be or should not be there as per Ind AS, remove them. First one, create assets and liabilities which are required as per Ind AS but they which are not there presently. Number one. Number two, which are there but not acceptable, remove them. Number three, which are there but classification wrong, so reclassify. Number four, items which are there or now create items which are there but their measurement numbers are not as per Ind AS. For example, you purchased equity shares some 10 years back. Your AS 13 says long-term investments have to be measured only at cost. So it is equity share. What did you do? You measured at cost. Last 10 years, investment in equity shares of some companies appearing only at cost. But you all know in Ind AS 109, what principle is there? Fair value principle, either FETPL or FETO, which means what? Cost is not acceptable in any way. You have to measure this at fair value. So remeasure it. Investments, even biological assets. Many examples are there. Share-based ESOPs are there. So ESOPs, for what adjustment is there? Oh, this I told you in ESOPs. But again, ESOPs, if you remember, in Ind AS 102, ESOPs has to be measured only at fair value. Whereas the guidance note which we used to do under AS regime, it permits intrinsic value also, but intrinsic value is not to be considered for ESOPs accounting and all. We have discussed that. So like that, measurement changes. So these four things are common. Now, one prima facie doubt you will get when I speak of all this. Sir, you are asking us to re-prepare this opening balance sheet as per Ind AS. For example, take an investment. The investment in equity share is there, which is appearing at 10 lakhs. Now, if I apply Ind AS on that, 10 lakhs won't be there. No, amount is going to change. When amount is going to change, that amount correspondingly where we have to give adjustment. Similarly, the PP is there. Because of Ind AS application, now PP amount either will increase or decrease. So PP will increase. Corresponding effect where will I give? Provision is there. Some liability number has changed. New liability has come. Where will you adjust the corresponding portion? For that, the standard says it must be adjusted in retained earnings or any other component of equity as appropriate. That means you can remember like this: all corresponding effects will go into other equity. Other equity of which date? This date. So here other equity. Sir, other equity means it's again a broad name. No, other equity where? No, that where normally is retained earnings, sir. Sometimes OCI item also acceptable. For example, investment you have been measuring at cost since so long. But investment in equity as per this Ind AS has to be measured under fair value. Suppose you selected FET-OCA. So the resulting gain or loss must go into OCA reserve. Okay, sir, no sir, I have selected FETPL. So today I will not prepare a P&L on the opening balance sheet date. No. So in that case, you will go to retained earnings. Generally, means I can't tell 100% all items, but 99% of the items will be adjusted only against retained earnings, sir. Only against retained earnings. One or two items are there where you have to adjust it against goodwill and all. That we will discuss a little later on. Timing, just remember that any adjustment in the amounts correspondingly give effect to retained earnings. So when so many asset items here, when their numbers change, so many liability items here, when their numbers change, or a new liability is created, new asset is created, asset is removed, liability is removed, all these effects will correspondingly go to other equity on the opening balance sheet date. You can confidently remember it as retained earnings. When exceptions will come, at that time we will see. Okay, sir. So this is how it's going to be. So now, sir, we have started with exceptions and exemptions. Before we go into that, it is better if we document some 4 or 5 points on what we have discussed till now. Okay, so take up your notes, sir. Only few points will come. Let's try to document that. So please write along with me, guys. This standard provides accounting principles for first time adoption of Ind AS. Normally, all the Ind AS must be applied retrospectively on transition to Ind AS. However, this standard provides certain mandatory exceptions and optional exemptions from retrospective effect. Retrospective application. First, Ind AS financial statements. The first annual financial statements in which the entity adopts Ind AS by an explicit and unreserved statement of compliance. opening India's balance sheet means balance sheet as per India's on date of transition. What is date of transition? Is the beginning of earliest period for which entity presents full comparative info as per Indians. So I'm not giving you the example as such because transition we have discussed in the beginning also. In fact, in the material they are there in it. So previous gap, I'm keeping it simple, sir. This is accounting standards as per companies accounting standard rules 2006. So we discussed all this. Next, general principle is to apply all indices in the opening India's balance sheet. The retrospective effect. This may lead to, so when you apply all the indices with retrospective effect, what will happen to the difference? What will happen in that opening balance sheet? So whatever we have discussed, that only, sir. 4 things will happen. Recognize all assets and liabilities required by Indians. So some items of assets, some items which are not recognized as assets and liabilities, you will recognize now. Next, eliminate items which are not recognized, which are not permitted by this as assets and liabilities. Reclassify the items of assets and liabilities as per Indians. The 4th one, remeasure. these four things. So